Performance measurement enables organizations to assess whether resources are being employed efficiently and organizational objectives are being achieved effectively. Modern management accounting extends beyond traditional financial analysis by incorporating measures of resource utilization, investment performance, service quality, and continuous quality improvement. Manufacturing and service organizations require different performance indicators because of differences in production processes, customer interaction, and operational characteristics. Consequently, a comprehensive performance measurement system should integrate financial and non-financial measures to support strategic decision-making and sustainable organizational success. Resource utilization. Resource utilization measures how effectively an organization employs its available resources, including labor, machinery, materials, facilities, and capital, to generate output. Efficient resource utilization reduces waste, improves productivity, lowers costs, and enhances profitability. In manufacturing organizations, resource utilization commonly focuses on production efficiency and asset productivity. Typical performance measures include machine utilization, rate, labor productivity, capacity, utilization, inventory, turnover, material, yield, overall equipment effectiveness, OEE. For example, capacity utilization measures the proportion of available production capacity actually employed. Higher utilization generally indicates more efficient use of production facilities, although excessive utilization may reduce flexibility and increase maintenance requirements. In service organizations, resource utilization emphasizes employee productivity and service capacity because services are labor-intensive and cannot normally be stored. Typical measures include revenue per employee, billable hours, occupancy rates, customer waiting time, staff utilization rate, service delivery time. For example, hotel occupancy percentage, airline seat occupancy, hospital bed occupancy, or consultant billable hours all measure operational utilization within service industries. Management accountants establish resource utilization measures by identifying critical organizational resources and selecting indicators that reflect efficiency, productivity, and capacity management consistent with organizational objectives. Profitability measurement. Investment centers and business units are frequently evaluated using return on investment, ROI, and residual income, RI, both of which assess managerial performance in relation to capital employed. Return on investment, ROI. ROI measures the profitability generated from assets employed within the business. ROI combines profitability and asset utilization into a single percentage measure and facilitates comparison between divisions of different sizes. Higher ROI indicates more effective utilization of invested capital and stronger financial performance. Residual income, RI. Residual income measures profit remaining after deducting a capital charge representing the minimum required return on invested assets. A positive residual income indicates that the division has generated returns exceeding investor expectations and created additional shareholder value. Unlike ROI, RI measures absolute value creation rather than relative percentage performance. Advantages and limitations. Advantages of ROI. Simple and widely understood. Facilitates comparison between divisions. Encourages efficient asset utilization. Links profitability with investment size. Limitations of ROI. May discourage managers from accepting profitable investments that reduce existing ROI percentages. Encourages short-term decision-making. Influenced by accounting policies such as depreciation. May not maximize shareholder wealth. Advantages of RI. Encourages acceptance of projects exceeding the cost of capital, focuses on shareholder value creation, reduces dysfunctional investment decisions associated with ROI, incorporates opportunity cost of capital. Limitations of RI. Difficult to compare divisions of different sizes, depends upon selecting an appropriate required rate of return, produces absolute rather than relative performance measures. Many organizations therefore use ROI and RI together to provide complementary perspectives on investment performance. Quality of service. Performance measurement differs significantly between manufacturing and service industries because of differences in output characteristics and customer interaction. Manufacturing organizations produce tangible goods that can be inspected before delivery, inventoried, and measured through objective quality standards. Performance indicators therefore emphasize production efficiency, defect rates, machine utilization, inventory management, and production costs. Service organizations produce intangible outputs that are consumed simultaneously with production and often involve direct customer interaction. Service quality depends heavily upon employee behavior, responsiveness, reliability, communication, and customer perceptions. Consequently, service performance measurement relies more extensively on customer-focused indicators. Examples of service performance measures include customer satisfaction surveys, complaint frequency weighting, time response, time service, reliability repeat, customer percentage, customer retention rate, first contact resolution, rate appointment, availability, net promoter score, NPS. Because service quality is often subjective, organizations must combine quantitative and qualitative indicators to obtain comprehensive performance evaluation. Total Quality Management, TQM. Total Quality Management, TQM, is a comprehensive management philosophy that seeks continuous improvement in organizational processes, products, and services through company-wide commitment to quality excellence. TQM emphasizes that quality should be built into every organizational activity rather than inspected after production. The approach encourages employee involvement, customer focus, process improvement, teamwork, prevention of defects, and continuous learning. The fundamental principles of TQM include customer satisfaction as the primary objective, continuous improvement Kaizen, employee participation at all organizational levels, process standardization and quality control, prevention rather than correction of defects. Data-driven decision-making, supplier partnership and quality collaboration. Management accountants support TQM by measuring quality costs, defect rates, process performance, customer satisfaction, rework costs, warranty claims, and productivity improvements. Successful implementation of TQM reduces waste, improves operational efficiency, enhances customer loyalty, lowers production costs, strengthens competitive advantage, and promotes sustainable long-term organizational performance. In conclusion, effective performance measurement requires a balanced evaluation of resource utilization, investment profitability, service quality, and continuous improvement initiatives. By integrating financial indicators, such as ROI and residual income, with operational measures and quality management techniques, such as TQM, organizations can evaluate performance comprehensively, support strategic decision-making, and achieve long-term competitive success in both manufacturing and service environments.